Whether you like it or not, when it comes to building a long-term portfolio, specifically a dividend growth portfolio, there are going to be a ton of obvious mistakes that are probably going to be made early on. Now, even though a lot of these mistakes are sort of a rite of passage for the long-term investors out there, I promise you that if you watch this entire video from start to finish, I'm going to share with you some of the top mistakes that you can hopefully avoid early on in your investing career. Now, this right here is my dividend growth portfolio, which I've been building for around 7 or 8 years now, and I've been buying different dividend paying stocks and ETFs across the market basically every single trading day ever since. Now, as of right now, this portfolio pays me on average around $6,700 more or less every single month, or around $80,000 in dividends per year. And unfortunately, I wasn't as lucky to come across one of these videos in my early days of investing, so I personally made a lot of the mistakes that we're going to talk about in this video. So if you want to see what 5 common dividend investing mistakes that you should definitely avoid, make sure to stick around, drop a like down below, and let's get right into the first mistake. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the first mistake that I think new dividend investors probably are going to make at some point, but you definitely need to avoid this with all your might if you can at least, is trying to avoid investing into high yielding dividend paying stocks and ETFs simply just because they offer a high yield. Now, I literally just Googled highest yielding dividend stocks. Now I'm on some random website right now where it's listing out a bunch of high yielding different stocks that I honestly haven't even heard of. Now, a few of the names on here I have heard of and I actually own, like Altria Group, but for the most part, during my early days of dividend investing, I would literally go on different websites and do different research and try to find some of the highest yielding dividend paying stocks because I didn't really understand dividend investing, of course, during my early days. And I thought, just like most new dividend investors think, that the higher the yield, the better the stock, the higher the yield, the more money that I'm going to make. Now, chasing high yield different dividend paying stocks and ETFs is not a good idea whatsoever. And again, this is specifically talking about buying into something, spending your hard earned money just because a stock or ETF is offering a higher than average yield. Now, this is because dividend yield on a stock or ETF is just one of the things to look at. There's a lot of other things to look at when analyzing an investment. I'm talking about things like a company's debt, a company's payout ratio, or even, here's a magical one, understanding a company's fundamentals. It should go without saying that buying into a stock or ETF with a high yield just because it has a high yield is probably a bad idea. But for those newer investors out there, please do not invest in something just because it offers a higher than average yield, because a lot of times there's a lot of risk that's associated with it. The next common mistake that you need to avoid, or in this case that you need to think about, is ignoring a company's fundamentals. Focusing solely on things like dividend yield without considering a company's fundamentals is most likely going to burn you long term. Now, as you can see right here, we're on the Realty Income website. I thought this was a perfect example to talk about when we're talking about fundamentals. Understanding Realty Income as a company, what their portfolio is, what this company actually does, how this company is doing financially. Those are things you need to ask yourself along with whatever company or ETF for that matter that you're investing into. Understanding fundamentals, even the basics, is going to be very important. And to be honest, this is something that I definitely ignored during my early days of investing. The next thing you need to avoid, especially if you're building a portfolio and you're in the earlier days, is to make sure that your portfolio is at least somewhat diversified. Now, this is because over-concentration in a few dividend-paying stocks or even ETFs for that matter can expose investors potentially to massive risk. Now, diversification, or even investing into something like an ETF, like the Vanguard High Dividend Yield ETF right here, is an ETF that has over 550 different stocks within it. So by buying a share of VYM, you're not buying a single share of a single company. You're buying a small portion of things like Broadcom, JP Morgan, ExxonMobil, Procter & Gamble. You're buying a small piece of a lot of different companies that have a history of performing pretty well. Now, diversifying, especially buying into ETFs, was something that I did not do enough in my early days of investing. I've talked about this time and time again. I really don't understand why you don't just build out a foundation in your portfolio, build the ground floor with high quality dividend growth ETFs like VYM, like SCHD, like DGRO. There's so many out there these days. They're super cheap to hold on to. This one costs just 0.06%. And this is because by buying into these ETFs for every single share that you get, you are getting instant diversification with the click of the button. You don't have to go through and purchase a small portion of 500 different stocks. By buying into something like we said, like VYM for example, and there's tons of others out there, you are getting massive amounts of diversification across multiple different sectors with a single click of the mouse. Now, if I could go back to my early days of dividend investing, that's probably the number one thing I would do, honestly. I would utilize these high quality dividend growth ETFs that own a small piece of tons of different high performing companies, buy these in the early days, and then later on do some single stock picking on top of that. The next thing a lot of newer dividend investors don't do in the early days, but can be crucial on long-term growth in the portfolio, is reinvesting those dividends when they start coming in. Now, of course, I didn't build a portfolio overnight that pays me north of $6,700 every single month. I started off like every other dividend investor. I received a 22-cent dividend payout from Realty Income, and then built that position up to where I was receiving over $1, and so on and so forth. But in the early days, even when you're only receiving a quarter here, $1 there, even though the cash balance is little, it's very, very crucial and important to reinvest those dividends back into more dividend paying stocks or ETFs, even into fractional shares, to allow your portfolio to start compounding right from day one, and to let your snowball, even if it's a small snowball, to start rolling down the hill and getting bigger. Now, my personal portfolio would not be nearly the size that it is today if, of course, I spent the dividends along the way. And although there's lots of times, even as of this moment, I got paid dividends today from a few different ETFs, it's very tempting to take out $200, $400, $600. It's very, very tempting to take out that money and buy myself something. But still, at this point in my investing career, I'm still in an accumulation phase. I'm still trying to grow the portfolio as fast as possible, as safe as possible. And because I'm still in that stage, I'm still reinvesting all the dividend income back into more dividend paying stocks and ETFs that are going to pay me more dividend income ongoingly. And this is because I want to build a portfolio that's going to compound itself out of control, which as of recently, it really starts to feel like that's taking place. Now, the last thing to avoid, or the last thing to be very aware about, especially in your early days of dividend investing, is understand dividend sustainability, or if not, a stock or ETF is going to potentially keep paying a dividend long term. Now, this right here is AT&T stock, one of my first dividend paying stocks that I invested a large amount into back in the day, probably during 2018, 2019. Now, luckily for me, I was able to sell out of my AT&T shares for the most part, I think, before this dividend cut took place. I think across my portfolios, I still own a small bit of AT&T, but nothing like I used to. Now, AT&T did cut their dividend from 39 cents per share per quarter down to 28 cents per share per quarter. And this is after AT&T not only paid a dividend, but also raised their dividend for several years ongoingly. And of course, after the fact, it's sort of easy now to look back and say that AT&T's dividend was not sustainable and the dividend cut was going to be coming sometime soon. But even still, many investors were blindsided and they saw their dividend income, their total average yearly income amount at that, drop significantly from this cut. So understanding whether or not a company can sustain its dividend payments over a long time period is going to be key, and especially something in the early days you're probably not going to think about, but I beg you guys, look into the companies, look into the ETFs, dividend sustainability, and ask yourself, is this asset going to be able to pay a dividend for a long time to come? So those are 5 different common dividend investing mistakes or common things to keep in mind, especially in your early days of investing. Now, even though it's normal in the early days to make some of the mistakes we talked about, I think that by watching this video, I can at least save a few of you guys out there to at least think about some of the things we talked about and maybe second guess yourself when it comes to stock picking or just generally building out your portfolio. But now lastly, most importantly, I want to hear from you guys down below. What is one common thing that you've made as a mistake in your early days of investing? Let us know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.